Is the latest inflation data as good as it looks? Here to discuss is Nancy Tengler of Laffer Tengler Investments. Nancy, we seem to be getting economic data this week in which the headline number looks rosy, but maybe when you look under the hood, less so. What did you think of today's Consumer Price Index inflation report?
Yeah, Lisa, the headline number was great, 0.2%. The core number was a little hotter than we've seen the last 3 months, but not as hot as we normally see in January. So in January, companies raised prices pretty much across the board. That's when, on average they do it. And so you usually get a hot number in January. It was pretty good. The negative part was services. And that has been a problem all the way through this inflationary regime where, we're getting the goods numbers to come down, but the services numbers keep going up and going up much faster. So thank goodness energy was down. That helped a lot. That's going to help the average family. Used car prices were down, so that's also good for the average family. But in general, I think we just have to keep our eye on services, and that's probably going to be less impacted by AI productivity improvements. I mean, a facial is a facial, and a massage is a massage, unless you've got an Optimus robot helping you out. But you're not going to do it in a shorter period of time, and so the productivity is not necessarily going to improve in that segment of the market.
Yes, people will probably still want their human massages and their facials. Okay, so take that combined with this week's better than expected jobs report. What do you think that this means for future rate cuts from the Federal Reserve?
So the jobs numbers are notoriously fickle, and we know they've been revised down dramatically over the last couple of years to the tune of a million and a million. So each year. So I think I treat those as sort of an interesting trend to look at. What we do know is that new business applications have soared to the highest level since COVID and even above COVID levels. So people are attempting to find their way through this AI driven environment where there's concern that white collar workers are going to be out of jobs. Those numbers were encouraging, but I think we have to see the economy string together a couple of months of those kinds of numbers, and I don't think we're going to see that. So we think the Fed is likely to probably cut at least twice this year, and that's just based on strong economic growth that could reignite inflation. Though we don't think that's going to happen, we think we're in kind of a disinflationary environment. But the Fed and I have rarely agreed, as you know, so I think they may be inclined to cut two more times.
Okay, let's switch to the software sell-off due to the AI disruption fears. I recall you liking ServiceNow stock. That stock is down roughly 30% year to date. Do you still stand by that stock?
And it was down 27% last year, Lisa. Is one of the most befuddling sell-offs that I've seen in my career. We exited. I mean, I do think some software companies are at risk. So we exited Adobe a while ago. Same with Salesforce.com. These are seat driven in the case of Salesforce and Adobe too, but Adobe didn't pivot fast enough to the whole AI threat. ServiceNow did, and ServiceNow is the conductor of AI on the cloud and is vertically integrating, to agentic security and many other areas of the vertical integration are important and I think are a moat for the company. But the market doesn't agree with me. So sometimes you can be right and still be wrong. Now we have not sold any. We've actually bought a little bit more in our portfolios. And I think this is one of the winners. But when the algorithms start selling, the hedge funds jump in, and it can be merciless for some period of time. I've written that this feels a lot like DeepSeek. And if you look at a number of the names that we held going into DeepSeek, think Teradyne, it was down 30% from DeepSeek to Liberation Day, and then it was up 132% from Liberation Day till the end of the year. So while I don't like this, it hasn't been fun. I think this is one of the survivors and ultimate winners in the AI race. But right now, as I said, the market doesn't agree with me.
Let me ask you this. When does the market reconcile its fears over the massive AI spending, or does it?
I don't know that it will. I think this is a great headline to drive the short sellers. What I will tell you is if you look at CapEx in line with historical trends, it's at the mean. Whereas in the 90s, it spiked way up, two standard deviations away from the mean, and then came down. And also in the 90s, we saw spending all decade. We're in the early stages of this, and I think when I grew up in the business, CapEx spending was a good thing. Like that's how you judged whether or not a company thought they had earnings growth opportunities. They were investing in the future. So I don't think it's egregious yet. And one man's CapEx spend is another man's revenue. So we like a lot of the hardware names and the infrastructure names like we own NVIDIA and AMD was in our 6 for 26. We own Cisco. We own GE Vernova and Eaton. So Quanta Services, Power. So there's a lot of beneficiaries still on the CapEx spend. And we've been using the weakness. We added to Microsoft last Thursday. We added to Palantir. We added to Apple, GE, Vernova, and Eaton, and we will continue to do that.